Welcome to Decision Vision, a podcast series focusing on critical business decisions. Brought to you by Brady Ware & Company. Brady Ware is a regional, full-service accounting and advisory firm that helps businesses and entrepreneurs make visions a reality.
Welcome to Decision Vision, a podcast giving you, the listener, clear vision to make great decisions. In each episode, we discuss the process of decision-making on a different topic from the business owner's or executive's perspective. We aren't necessarily telling you what to do, but we can put you in a position to make an informed decision on your own and understand when you might need help along the way. My name is Mike Blake, and I'm your host for today's program. I'm a director at Brady Ware & Company, a full-service accounting firm based in Dayton, Ohio, with offices in Dayton, Columbus, Ohio, Richmond, Indiana, and Alpharetta, Georgia. My practice specializes in providing fact-based strategic and risk management advice to clients that are buying, selling, or growing the value of their companies and intellectual property. Brady Ware is sponsoring this podcast, which is being recorded in Atlanta per social distancing protocols. If you would like to engage with me on social media with my chart of the day and other content, I'm on LinkedIn as myself and at Unblakeable on Facebook, Twitter, Clubhouse, and Instagram. I also recently launched a new LinkedIn group called Unblakeable's Group That Doesn't Suck, so please join that as well if you would like to engage. If you like this podcast, please subscribe on your favorite podcast aggregator, and please consider leaving a review of the podcast as well. Today's topic is, should I pursue impact investing? And according to SG Analytics, the impact investing market as of late last year was $715 billion. And you can question what is impact investing, and in fact, we will. And those of you who are veterans of listening to this podcast know that we try to set our definitions early so that we know exactly what it is that we're talking about. But, I think with a number of forces that are converging as we record this podcast on January 27th, 2022, I think there's renewed interest, and indeed I think we'd find there's data that demonstrates there's a lot of renewed interest in so-called impact investing. Between a renewed social reckoning in the United States on race, between or considering the sharp polarization of our political system, and people say that it's been this bad before. I don't think that I agree. I think it is worse, and I think it's being made worse because social media gives everybody a voice, and not everybody should have one. But that's a different philosophical topic. In addition, the pandemic itself has forced us en masse and has led us as individuals to reevaluate our lives and our relationships, whether they're personal relationships, whether they're work relationships, something else. Many of us are now prompted to, and perhaps given the courage to, abandon relationships or sources of energy in our lives that frankly have become, or maybe had long since been toxic, but we're now realizing just how toxic they were. And behind this whole backdrop, there's this whole thing called climate change. And I'm not going to debate whether or not climate change is real or not. Cards on the table, I do believe that it's real. And I believe that it's real in large part, not because of what I observe, and not even because supposedly 97% of scientists, quote unquote, 4 out of 5 dentists, whatever it is, say that climate change is real. It's really because I understand the math, and I'm fortunate that a dear friend of mine who's a tenured professor of environmental policy at Emory showed me the math, and I understand how the math works. I understand not everybody else does. If you haven't taken advanced calculus and statistics, you're not going to understand the math. You just don't. But to me, I understand it as a matter of math, but I'm not going to try to convince anybody. And frankly, if you think that climate change is bunk, you probably aren't listening to this episode, or you won't be for very long. So I don't think this is a debate that we need to carry here. And you know where to find me on social media if you think that I'm a tree-hugging communist. But for the rest of us who are still here, impact investing is a thing, and there's renewed interest in it. And the thing that I find so compelling about about impact investing is capitalism is an economic system that is capable of accomplishing tremendous things. But it is also not perfect. We have not found a perfect economic system. I'm not advocating for either one and another. But man, when capitalism gets behind solving a problem, it freaking gets fixed. And there's ample evidence that I can point to. But also when capitalism gets behind creating a problem, that problem is also amplified, magnified, and scaled up very quickly, right? So it's like a power tool. A chainsaw is great to cut wood, but I wouldn't recommend it to use on your own kneecaps. So to help us understand and think about impact investing and whether or not impact investing is a model that you should consider, whether it's in a portfolio, whether it's making corporate investments, venture investments, I'm going to introduce a friend of mine, a really cool cat, Mark Hubbard, who we've known for longer than I think either of us would care to admit. Neither of us had gray hair. That's how long ago we've known each other. And before I get into this, I want to offer a very important disclaimer: is that we are going to talk about investing today, but in doing so, we are not making any kind of investment recommendation, whether or not you should or should not make an investment of any kind. Stuff it under your mattress, Bitcoin, NFT, Russian rubles, I don't care, right? So before you make any kind of investment decision, consult somebody who knows what they're doing, preferably somebody that you're paying for their advice so that if they screw up, you can sue them. But get an adult to actually give you that advice. You're just listening to a couple of old white dudes talking. And if you're going to make an investment based on a couple of dudes you don't know on the internet, that's on you. So by listening further, that is a disclaimer that you are now accepting. Somewhere, some lawyer just had a heart attack, but it's all right. Mark Hubbard is joining us for today's program, and he's general partner of Renew Venture Capital and CEO of Pixel Recess, a design and venture studio. Mark has founded, invested in, or mentored thousands of enterprises from startups to global corporations in his almost 30 years in venture capital, global private equity, and institutional asset management. He has directed billions of dollars of capital, launched one of China's most successful asset management JV. I forgot about that. I remembered when you did that. Founded a global private equity firm and built innovation centers for cities and states. He has spent decades deeply immersed in the impact space since long before it was called that, long before it was a thing. Back then it was called tree hugging, I think, on both the founding and funding sides of the table, and has led on the forefront of the integration of faith, theology, philosophy, and investing. Mark's father was a theater professor. Everyone in his family is or has been a teacher. And he grew up as an actor and musician. And in fact, Mark having a guitar in his office led me to have a keyboard in mine. So he's had that influence. He started college as a chemistry and classical guitar major and graduated with a finance and environmental science degree along with all his Wall Street licenses. Art, science, math and beauty, service and commerce, for him, all are inextricably intertwined. Buckle your seatbelts, everybody. This is going to be an interesting one. Mark Hubbard, welcome to the Decision Vision podcast.
Thank you so much. So I have guitars in the background of my picture that you all can't see, and you've got keyboards in the back of yours. So I say we scrap all this and let's just play some music.
You know what? That's true. Fire it up. In fact, I was just talking to a friend of mine. We were in a band, BC, before COVID. Uh-huh. And, neither of us are playing out right now, especially during the cold weather. And we're kind of, when do we get back to it? And, as a performing as a semi-professional musician, when you don't have somebody to perform for it, you let things lapse. I don't even know if I can turn the damn thing on right now, let alone actually play and not hurt myself.
Yeah, me too. I haven't played in a while. Well, first of all, just let me say that we have known each other for a long time. And I think you just proved this through your introduction, but, you're maybe the smartest person I know, but you're also, kind and curious and thoughtful. And so it's an honor to be here and talk about this topic in particular with you.
Well, thanks everybody for coming on the Decision Vision podcast. I think that's all we need out of him.
That's what did I do that the way you wanted me to?
Yes, you did. Yes, okay, you did. Yes, you'll find the token in your crypto account at the end of the day, in your e-wallet at the end of the day.
Okay, good.
All right. So, I let off I led off with a topic with a notion that I'd like you to help us out with,
Mm-hmm.
and that is impact investing. I don't start off with the stupid, Oxford Dictionary defines impact investing as da-di-da-di-da. How uncreative is that? But I would like to know how somebody like you who actually puts capital to work in impact investing, how do you define it?
Oh boy. All right. Well, I think it makes sense to go first back to the trend that you mentioned. Certainly coming out of out in quotes of the pandemic, we have had people make this reassessment, right, about their lives and relationships and their work. And I've heard you say things about it, right? Like you'd like to be able to talk about basketball without feeling like you're on the clock as an accountant.
Yep.
And yet that's really part of a larger trend, right? That's been going on for probably 20 or 30 years, or, maybe even more, where when I, as an old man, when I was growing up, what I was told, or, just sort of in general by society, is that you sort of tried to live a two-pocket life, right? The first time I heard this was really from maybe Kevin Doyle Jones, where if you went to see a really successful rich person and you wanted to talk to them about something like impact investing, they would say, why I don't invest in companies that are trying to do good. What in the world does that even mean? I have two pockets. I have one pocket that I put all the money in the world into, and then I have a pocket that I give to, my taxes, and I give to nonprofits, and they can do the good in the world. And those two things don't cross over, right? So like relationship George and independent George, like those two things don't meet each other.
And that's very much from the Chicago school, right? That's a very Friedmanian.
It's all of it. All the bad stuff goes back to Friedman.
Yep, that's right.
in general, and so people just don't want to live that way anymore. They don't. They want more integrated lives than that. They don't think that's necessary. That's a value system that was sort of foisted on them, and they don't feel like they need to live that way anymore. And if you're not going to live that way, then part of the way that you express who you are is through your work and where you spend your time. And part of the way you express who you are is with your money. And so that's been a big driver over the last 10 to 15 years in the impact investing space, is that larger trend of folks saying, I'm not interested in bifurcating things anymore. I want to figure out how I can, the old mantra is do well and do good. I want to figure out how I can live my life as integrated as possible so that everything expresses what I say I believe.
Is impact investing synonymous with the ESG, environmentability, sustainability, and governance? Is one a subset of the other? Are those two interchangeable? How do those two concepts fit or not fit?
Yeah, here's the problem. It's that impact investing sort of isn't a thing, in a way, right? None of the things that you'll hear said commonly in any parts of the market have all that great of a definition in and of themselves, and they all really fit on a spectrum. So if you want me to, I can sort of lay out what the spectrum looks like, if you think that would be helpful.
Yeah, I actually do. Yes.
Okay. So on one end, you sort of have Milton Friedman land, right? Where the business of business is business.
Yep.
Where all that matters is money. All that matters is shareholder return, right? Like a business is really just there to do business, make money. That causes you to push off all kinds of externalities, right? Environment being one of them, but all kinds of things, right? Because what matters the most is yield. And that still exists. There's still people who run businesses that way. We think that way. We think that's the way things should be. That's sort of on one end of the spectrum. The next step up sort of is CSR, right? That's what a lot of people talked about for a long time. Corporate social responsibility. Really the idea of CSR was how do I look at the business we're running and limit the damage we do, right? So not so much proactive good, but how do I make sure we limit damage? Right above that, I'd say, is ESG, okay, which you mentioned. So ESG is environmental, social, and governance, which is sort of a mix of those two of limit damage and do good, right? Like you find proactive ways in those three categories to adjust your business, the governance of your business, the policies of your business, the way you engage with suppliers, the way you engage with employees, right? So that you can address those three big categories. That ESG piece is the biggest part of what you'd think of as the impact investing world right now, right? Because that's really the only kind of thing you can do to apply to public markets, which are so much bigger, right? And so when you apply that lens to public markets, that's where most impact investing, quote unquote, money comes from. And if you include that, it's something like a $40 trillion market right now. So it's massive.
And what I find fascinating about ESG is how the G, the G isn't something that people, I think about as much. Governance is a lot like an umpire, right? Governance is doing its job when you barely notice it's even there. It's when it really screws up and blows that call at home plate that you notice that it's there and it's doing a bad thing. And I think that's probably why I find it fascinating, because it's so subtle. I think you can make an argument that it has as pervasive an impact, getting back to that term, as the E and the G and the E and the S part of it. Because without the right governance, it just undermines so much of the other things that you're trying to do.
Yeah, I mean, if you just think in sort of two categories of that governance, or let's say three, right? Board composition, executive compensation, right, and corporate policies.
Yep.
Well, that determines all of the rest of everything. those three things, and those are all governance issues. And so that's really the biggest part of the market. There's sort of a step above that, which they call stakeholder capitalism, right? Which is trying to say, businesses, workers, customers, communities, environment, and shareholders, that there's those five stakeholders. And that when you run the business, you sort of have to balance the interests of those stakeholders as you do it. You don't just always defer to the shareholders.
Yep.
And then above that is what I call impact investment, which is companies that are intentionally and actively doing good, right? Built into the business model. I mean, really, there's two kinds. There's sort of bolt-ons like the Tom Shoes of the world, right? Where you say, I'm going to, you sell one and give one, and that's fine and all. And, those businesses made some progress in the marketplace. But the interesting ones are the ones where it's baked into the business model. So the bigger the company gets, the more profitable the company gets, the more impact it does in the world. Those are really the ones that, certainly the ones we're looking for, and the ones that I think are the most interesting.
So I'm going to ask the question now. I'm sure you've been asked many times, and it may be the one question most of our listeners care about. So I'm going to get it out of the way. So if people want to stop listening, they can do something else. And that is the most common perception about impact investing is that by definition, you therefore must be sacrificing financial return. Is that true?
So I'll be controversial.
Please do.
Here, I think
it's only the internet.
Yeah. Well, number one, that's not true. I mean, there's no data to support that really whatsoever. All of the data you can look at, I mean, and there's, tons and tons and tons of it now. Just go through McKinsey's website alone. All says that, well, if you look at ESG, right, that ESG performers they grow faster and they have higher valuations. They have lower costs. There's data about women-run companies outperform, women investors outperform, right? Immigrant-run companies outperform. No, it's just not true. In fact, what the generalized data will tell you is that you get better risk-adjusted, right, rates of return if you are sensitive to these issues, right? If you use this as a lens. Now, the challenge for me is, the controversial part is, look, everything I'm about is generating those returns. So it's not like I don't care in that way. But in the same time, I sort of don't care. Like, for me, there's also a right thing to do. Mm-hmm. And that's part of this. I mean, look, that, the idea that we have this idea sort of in culture right now that, right, that you can't, nobody should make exclusive claims to truth, right? That, if you make an unprovable exclusive claim to truth, that's what's wrong with society.
That's your philosophy background right there, man. I love that.
Which I don't know is fine, and sometimes that's true. I mean, make that claim. The challenge is that's an exclusive, unprovable claim to truth, and you just said nobody else could do it, but you can. And so there's this idea that risk-adjusted return, right, is the only thing that matters, and that even I have to put the good parts into a risk-adjusted return model, right? That's the only thing that matters. But that's an unprovable assertion of values, that making more money is what makes you happy and is the only thing that matters. And so I just don't know that value system doesn't match with mine necessarily, even though all of the numbers will say, yes, you'll actually do better if you impact invest.
Right. So, so let me ask you, let me run a hypothesis by you, and I'd like you to tell me if you think there's validity to it, or if you think it's full of crap. And that is that I think now there's a particular differentiator now impact investing, in that I wonder if impact investing is going to provide companies with two advantages. Number one, I think it will enable them to attract the best talent, particularly young talent. You know, we're both Generation X. We're still in that puritanical, for the most part, as a generation. We're still the keep your mouth shut, do your job. We're kind of the last of that generation, right? But the generations behind us are like, no, man, you shut up, because I'll go independent. I'll work for somebody else or whatever, right? So if you're going to attract the best talent, you know, once people like you and I start to age, like you and me start to age out, that's going to be a problem if you don't kind of adapt to that. And the second, and this was a concept that was posited to me by another friend who was on the podcast actually, and he suggested if you want to build resiliency in your company, take away one of their resources for a while, make them play left-handed, right? With the notion being that it forces you to become better if you have restraints and bumpers and guardrails, right? And so I wonder now, can the restraints and bumpers and guardrails of impact investing actually force you to become a better company because you can't be as intellectually lazy?
Yeah, so I'll answer, I guess, in the context of what I'm doing with my life, right? So we have a venture capital firm. We're raising and deploying capital, and we really do it under two themes, right? And the first thesis is what you just mentioned, is that, look, impact companies that want to be big companies, that some of the best founders in this generation coming up, right, are going to be founders who want good for the world, deeply integrated into what they do, right? And they're going to need to be able to attract the best talent. And they're going to need to run through walls like all founders do, right? And when you look at all of the things that make a founder successful, you get more of them out of an impact focused founder than you get out of anybody else. That 70% of people say they want sort of mission related in their work, and 15% of them say they feel like they have it. And so an impact founder will run through walls because they're committed to mission, right, in a way that people who are only committed to money won't. Yep. And by the way, since it's a relatively underserved market, there'll be opportunity there, right, that other people don't run after. The other theme we follow is, the other thesis is that investing in women founders and historically excluded founders is really the biggest mistake that VCs made. The lack of investment in that world, and that it continues now, and that's all about, look, success in venture capital is all about TAMs, right? It's all about, can I see a market, a total addressable market that other people can't see? And when you look at all the big successes of the last couple decades, when you look at Uber and you look at Airbnb, right, the real magic in those is that there were TAMs there that nobody saw, nobody knew were possible. And so if you have a whole class of people, these giant groups of people, where arguably, genius is equally distributed among, they're going to be able to see all kinds of markets that the rest of us won't. And that's where you produce success, is by finding those kinds of opportunities. So yeah, I mean, I think all of it makes sense. Now, the nice thing for us is I don't have to play in the big ESG complicated public markets world. Mm-hmm. I can just say, I'm just going to select the best companies we can find, right, that happen to fit this opportunity set.
Yeah, and I think the best exemplar of that, not that I think he's flawless, I think he's highly flawed, but Elon Musk, I think, is exemplary of that with electric vehicles. The electric vehicle was considered, very much a fringe product, a compliance product. I was an early adopter, but most people weren't, and I get it. Now everybody's bringing electric cars to the market. They've gone to being, from 10 years ago, less than 0.5% of the fleet, now to about 3 to 4%. And probably, I would guess, I think in about 10, 15 years, you will not be able to buy an internal combustion engine car in the United States, because nobody except for like big time gearheads are going to want them. But Elon Musk, for all his flaws, and boy, he has a lot of them. He's an example of a guy who saw that market a long time before anybody else did.
Yeah, well, it's also an example of what you said earlier, that business and markets are much larger than government, right? Action. Yep. And they're like an order of magnitude, several orders of magnitude larger than philanthropy, Right. And so if we're going to address some of these big societal challenges, we have to do it through business and markets. It's the only way you can achieve the scale. And by the way, businesses also have a way of sort of webbing their way right throughout all of life and all of activity in a way that those other two, issues can't, good and bad. Right. And that's how you actually end up changing systems at scale.
And that, I want to expand upon that because that segues into the next question that I think is so important. Conscious capitalism, if you will, is a model for accomplishing this, but it's not the only model for accomplishing this. Somebody would argue, a Marxist would argue that government should be in charge of making this happen because you effectively have streamlined decision making. You collect taxes from people, and then they can decide they're going to have all the data, and then they can decide in whatever wisdom they have that they're going to make 5 or 6 things happen with all that capital because they have that leverage. And then there's another, maybe it might be a quasi-libertarian model where let nonprofits deal with this, right? Let a market for nonprofits evolve from this. Let social capital find those nonprofits and let the market settle that way, right? So you've chosen this particular model. You've chosen capitalism as the engine for this. Why do you believe that it's a better tool than the other two that I mentioned?
All right. So why do I believe it's better than Marxism? Let's see. Let's start with that. And the funny thing is actually the other side, the libertarian version of that, right, is the Bill and Melinda Gates Foundation.
Yep.
Right. And they're amazing and nothing against, any of that. But the other idea is that idea that you concentrate as much wealth in the hands of the smartest people, right? Quote unquote. And then they decide, right? Like the Aspen Institute decides, and like you get the most powerful people basically judged by how much money they have together. And it's another version of that same thing, right? It's the capitalistic version of this is the group of people that will know best. And they're the ones with the resources anyway, and let them make the decisions about what happens next for everybody, right? The Ayn Randian model. And so, look, anything that ends up producing good is a good thing. Like I'm a fan of, and I'd love to make that happen. And they all, in all parts of the marketplace, right? As with any ecosystem, those players serve different pieces of the marketplace.
Yep.
None of them can meet the level of need that we have, right, without involving business, right? It's just not possible. It's not going to happen, even just in the terms of climate change. Like we're not going to out-regulate ourselves, right, to it. So none of them can accomplish what we need to have happen. And frankly, people are going to be founding businesses and running them anyway, and those businesses are going to be having an impact anyway, and your money is going to be invested in having an impact anyway. And so I can be unconscious about that, right, and unstrategic about it, or I can decide that this is my lane, and this is where I'm going to direct all of that activity and power and leveraged action, right, into something that reflects what I think I care about and the direction I think the world should head.
So you're in a position where you're committing, grown-up levels of capital to these kinds of opportunities. And I'm kind of putting myself in your seat for a second. And by the way, awesome seat, but it must make due diligence a bit more complicated, because it must add at least one more dimension to what you're analyzing, and then also complicates your own governance, if you will, monitoring your investment, because it's not just now about financials, but also impact, however we define that. I want to come back to that in a minute, but that's I would imagine it's got to be true. And really, frankly, more true than you could possibly even know, right? Because evaluating, I set off Siri, I think, evaluating financial metrics, right, seems like it's a super easy, straightforward thing to do. I'll argue, sometimes I'll argue whether that's the case in things like business valuation, for instance. Yep. But a lot of what we're talking about are, some of the things are absolutely quantitative, right? And you can figure out quantitative things like carbon output and those kinds of issues.
but a lot of it is qualitative, right? Not quantitative. And the qualitative stuff's hard to define. Number one, that's a rough start. Then it's hard to measure, right? And then it's hard to measure what the impact of the measurement is anyway, right? Like that's a complicated thing. I pulled this one quote in case you asked this question. It comes from at the end of last year, some GPs got together. So some fund managers who are running money, doing the kind of thing I do, trying to figure out how they also report to LPs, right, on impact. They decided to start making their own. Right. So they're going to start reporting on metrics in scope 1 and 2 greenhouse gas emissions, renewable energy, board diversity, work-related injuries, new hires, and employee engagement. So they're going to make up a metric. But here's what the next sentence is. These metrics borrow from existing ESG measurement frameworks created by CDP, CDSB, GRI, SASB, TCFD, and others, and broadly aligned with stakeholder capitalism metrics introduced in September by the World Economic Forum.
I totally get it now.
So I know there is no language. Like there's no common language. There is no common metric. It's not like it's not like you just decide we're going to do it in dollars. It's across the board. And by default, what people tend to do often is say, well, we'll make up our own rubric. Like we'll come up with our own way to approach all of this. And so, yes, there's a level of complexity sort of beyond just deciding whether the financials look good and the market's big enough that we have to evaluate and believe in because we're committed to that mission too. But when it comes to reporting, yeah, it's a nightmare, and it's a nightmare for everybody. And I don't know that I don't think it probably will ever be solved. There's too many people in positions of power who make money off of it being complicated.
Yeah. My field of accounting is discussing, there's a need, and frankly, I think a great market opportunity for audit firms to figure out how to measure and independently report impact. Mm-hmm. Right. And eventually we're going to solve that. As is often the case in accounting, we don't address these issues nearly as quickly and as robustly as I think we need to or could. But it's definitely on the radar screen there.
Yeah.
And then it's funny. Go ahead.
I was just even in business valuation, right? So you're the king of all things business valuation. So how do you decide the value of a business? So you tell me the quick and dirty.
Well, oh boy. So, all right. So you're interviewing me. That's fine. So so I have to start with a definition of what I think a business value is. Okay. Mm-hmm. And it's a little bit different than what most people will tell you it is. To me, a business valuation is a prediction of the most frequently occurring price that would occur if an asset were traded back and forth 1,000 times within 5 seconds. Right. So it's a point estimate that tries to mimic what would happen in a random distribution, which would probably be a bell curve or a log normal distribution. Okay. Right. How do I do that? I take a bunch of information, I triangulate it with one another, and at the end of the day, I sprinkle what's called my informed professional judgment, and I produce an appraisal, which is my personal conclusion of value.
So there is so the point is, right, that there is an art in there that isn't science. There's some layer. There's some layer of that fundamentally affects the equation. It goes back to the old. Oh yeah. You can value a business. You look at all the numbers. You come up with and then you ask, well, what's it worth? Well, it's worth whatever anybody will pay. And so as you said, right, it's you try to figure out what somebody would pay piece, but there's art in that. Like there's. That's why I'm not a website. Yeah, right.
If we're all equations, right, there would be no job for me. It would be you pay $50 and get your valuation off a website.
Right. So it's the same. So the same thing is true, frankly, in the investment world, right? Like those same kinds of rules apply. Like we like to pretend like it's all easy to evaluate just based on the numbers. And the truth is all of it is art. What makes the difference, what creates alpha? I mean, you can index everything and that's fine, but what creates alpha is insight and art. That doesn't just exist in the numbers.
Right. And it has to, again, because if it did exist in the numbers, everybody would know it. The program traders would have already figured out and the alpha goes away, right? So it's self-defeating. Right.
Which is going to be true in impact metrics. There'll be some irreducible aspect of that across the board, no matter how much you try to figure out how to standardize it. And frankly, although there's tons of energy around the idea that we want to standardize, all of the energy is associated with how do I create my own group to standardize it.
Yep. So let me ask a very cynical, but I think fair question. And that is, as you as a decision maker on behalf of capital, how do you tell or how do you make a determination? And admitting that this is going to be, of course, and again, your informed professional judgment, but what do you consider when making a determination as to whether or not an advertised impact is legitimate as opposed to simply pro forma, right? And I liken it to the old term greenwashing.
All right, here's
what does your bullshit detector for that look like?
Yeah. Well, here's where I get to punt a little bit, in that's particularly applicable to it's particularly applicable to nonprofits,
yep.
Right? Which we don't really play in, and it's particularly applicable to the public markets, where things are ridiculously complex, right? Where an impact report that a company puts out itself, right, without even any audit, is 200 pages.
Yep.
And so trying to figure out in the context of a giant, multi-billion-dollar public corporation, what's real and what's not real, what's washing and what's not washing, is incredibly complex. And yes, there are consulting firms that do very, very, very well, right, being on any particular side of that, helping them prove, evaluating whether or not that's true, right, all of that stuff. I don't have to do that because I'm just picking companies to invest in at an early stage.
Okay.
Right? In an early stage, things are a whole lot less complicated.
Okay.
Right. And so we're on the impact side. We're really on both sides. We're really just making what would be traditional venture capital investment decisions. What we're picking, right, are companies where the impact is webbed into what they do so thoroughly that as that market gets achieved, as they continue to grow, it can't help but have an impact. Right. So, I can give you an example. So we have an ag tech company that does these containerized farming systems. And so all he's trying to do is build a giant company of distributed farms right across the country. Within that, because of that, a natural byproduct of operating that business, right, are things that address food deserts, are things that address climate change.
Yep.
Right, are things that address
water conservation,
economic mobility. Right. There are, and so the bigger that company gets, the more those impacts happen. That's pretty cut and dried, right? That's not particularly complicated. Now measuring it is, and figuring out how you talk about it is, but making the decision about whether or not you invest in that is an investment decision around the business, not so much around that provable impact piece, because it's part of what they do.
Do you find that it's harder, easier, about the same to source viable investment opportunities when you have the impact filter as opposed to being unfiltered, where you can invest in tobacco and toxic sludge and everything else, right?
Right. So that's a really interesting question where the answer is it depends on what you mean by filter, right? Because look, my job is to look for opportunity where others don't see it, and that's aided if you have some limitations, like you talked about before.
Yeah, well, and that's the thing. I can see the argument both ways, right? On the one hand, if you open the door and say, you know what, I'm open to investing in any reasonable business opportunity, right? That means a lot of stuff comes to the door, but you also are going to have a lot of competitors who want that same stuff walking through the door. And there's much less to differentiate you. On the other hand, you say, I'm Mark Hubbard and I'm an impact investor, right? Okay, well, I sell tobacco to children, so I guess he's not going to be in my bailiwick, right? Or I make coal dirtier. That's probably not going to be a good fit. So I'm not going to do that. But on the other hand, the solar panel guy, the aquaponics woman, whatever, says, Mark really likes this stuff, so I'm going to go to him first because I know he's not going to laugh me out of the conference room or off the Zoom call. Yeah. And by the way, not as many people are into this yet. Yeah.
Well, I mean, look, the selling tobacco to children I'd be up for, but the other stuff, no. So no, I think you're right. Look, when you're raising money as an early stage founder, you have to find investors who get what you're trying to accomplish, understand it, and can add value, right? And I know we keep talking a bunch about me, and that's great because I love talking about me. He says sarcastically. But this group is, Renewed Venture Capital is 70% women. Like we're white and black and brown and immigrant. This isn't done by me. I can't do it. mean, what you just mentioned, right? Do all those people, well, great. I don't see opportunity the way, the black women on my team would, or the way the Colombian immigrant on my team would.
Yeah.
And I also can't connect to those founders in the way that they can, right? The more lived experience you have, the more empathy you have, the more successful a business is going to be, the more successful a product is going to be. And so another very important piece of it is that it's not just, me, white dude, as important as that is to have the white dude.
Yeah. And he says that about talking about himself. It was easier. It was more plausible for me to get the Kremlin's battle plans for Ukraine than it was for me to get a bio out of you. So, but thank you for coming through at the last second.
Thanks.
So, does impact investing either compel or lead you to think about risk differently than if you didn't have that filter?
So a complicated answer. What the marketplace would say, what the ESG and what Goldman Sachs and their impact group, right, would say, is that's what it's all about. But that's how it works. I mean, impact investing came out in 2010. JP Morgan did this research report, and they said, we think impact in the next decade, impact investing could be $1 trillion asset class. Right. And so as asset class, that means like you buy your small cap stocks and your large cap stocks, and you buy some impact stuff. Right. Now it's a $40 trillion market. And so they were really wrong. And but how they were wrong was that it's not an asset class, it's a lens.
Mm-hmm.
And so it's how you evaluate all the asset classes now. Right. That's how Goldman, impact metrics are a part of how Goldman Sachs evaluates every asset class it invests in. And once it becomes that, the only, Goldman Sachs can't run around talking about values, right? Like the only context you can have to make a justifiable decision about it then becomes risk adjusted return. And so all of it is about, if they ran the risk adjusted return numbers and said, it doesn't play, you'll do worse, right? Then they wouldn't make those decisions. So yes, it should lower risks. Now, the challenging part for me is risk adjusted return, number one, makes you again only care about return, right? Which is complicated, right? Like how do we get our kids to not lie? Yeah, we tell them that they, you'll be found out, and I'll punish you, and no one will like you, right? So essentially, fear and pride. And now I'm a grown up, and pretty much the only reason I ever lie is fear and pride. And so like if you just reinforce the bad thing in a different way, like that's not for a better outcome. It's not necessarily productive.
So when we talk about risk, I guess what I'm trying to get at is, let's think for the moment. I'm going to put on my economist hat. One of the things about impact investing that I think can differentiate it and maybe necessitates a mindset change is. I think if you're kind of outside the impact investing tribe, for lack of a better term, and there probably are 9 better ones, the only one I can think of, you think about impact and financial returns in separate buckets. But I think an enlightened economist would say they're total return. We just don't know how to measure the impact return yet. Right, but there is some sort of utility. Now I'm a real economist here. There's some sort of utility function.
Yes.
Right, that's going to match up with an isoquant. Right, that they're going to overlap. That's going to match, my desire for overall return versus the availability of risk adjusted investment opportunities. Right, and so my question is, or the follow-up question is. If you assume that premise, that in fact, almost by strict math, impact investing must generate a higher total return, even if only a subsegment of that or a segment of that is pure financial return, right? And we know that the law of gravity in finance says that higher return only comes with higher risk. Otherwise, you have an arbitrage opportunity, assuming efficient markets. Ergo, it must mean that you think about risk differently in order to pursue impact investing. And in fact, you must be willing to accept a somewhat higher or adopt a higher risk posture in order to make yourself, or in order to lead yourself to make those investments. Otherwise, the economic narrative, it doesn't mean that it's wrong, but it means you almost have to reinvent an economic language.
Yeah. So, I mean, look, you're really talking about two things. One is there has been an effort in the impact investing world to figure out how you monetize that but how you systematize that qualitative piece of it, right?
Sure.
And that's blended value. That's what folks have talked about, right? And really, Jed Emerson was probably the lead on that.
Okay.
Who helped create that. And that was a way to try to say, look, so we can report to you, here's your financial returns, here's the social returns. And so then here's a blended profile. I don't know how much the marketplace has liked that. Honestly, it seems like, I've been in plenty of investor return meetings where they're really engaged in the financial return part of that discussion, and they glaze a little on the social part. So number one, that's been a complicated part of the marketplace. Number two is the research says that that's not true. Like, the research says that your risk is lower by doing things like ESG, because what you've been doing in the past is not correctly evaluating the risks you were exposed to, right? And so you miss this environmental risk, which is going to cause you a whole bunch of brand damage, which is going to change your marketplace, then you're going to get overregulated, and you're going to have to address, right? And so if we address all those, if we start including that risk into the model now, right, now I can make decisions that are less risky. And the whole reason you make a decision that's less risky in that framework, right, is that it will redound to performance. Is that lower risk will also give me some better performance. It's a weird, right? It's the opposite of what you normally think of as it's not an asset class discussion, right? So it's not you took more risk in venture capital, so it should get you higher returns. It's a management of business question, right? Which is a little bit different. The challenge for me is, and to bail on my other answer, the challenge for me is that risk adjusted return is really 100% about time horizon. And that's part of what makes it so complicated too, is that if you really feel like that you can destroy the environment like crazy for the next 5 years and then make a pivot, right, at that time, and have it not hurt you all that much, and especially not hurt you, and look, if your time horizon is only 4 years and all you care about is money, right, then awesome. And that's so again, as a motivating factor for me, that's awfully complicating. And so I have to have some other driver of why I should do it. And I do have sort of values-based drivers for why I should do it. But all of the data will say that it's actually less risky to adopt this kind of exposure.
And good. I'm glad you brought that up. And there is actually a logic to the narrative, because you characterize ESG with the S being social. I characterize it as sustainability. I think I've heard it used both ways. But because my way helps make my argument, makes me sound smarter, I'm going to embrace that. But but sustainability by definition is linked with risk, right? By definition, something that is unsustainable is going to be higher risk, right? And to your point with long-term investing, one of the dirty secrets about economics is that economics is great when you're talking about time frames that are measured in generations.
Yeah, awesome.
When you're talking in terms of calendar months, it really falls down quite a bit. And we've actually found that really since 2008, a lot of the things we knew were true in economics just aren't. And it's really put the entire field into crisis. But that long-term plan, this gets back into the filter or the constraints causing you to be better too, because the data I've seen indicates that even if you don't have the impact angle, right, that impact in itself makes you a better business, simply adopting a long-term posture, right, of 10 to 20 years versus the typical VC time horizon of 5 to 7 years. And it turns out that 5 to 7 years is, for most companies, when they're just getting started, to be interesting, right? Just that, again, being forced into that longer term time horizon forces you where the market wants you to go. It's like playing a game of chess and your opponent plays a move and thinks he's got you, but he's forcing you to doing something you wanted to do anyway.
Yeah, no,
and I find that so elegant.
Yeah, no, I think that's right. That the more you can integrate sort of the future of what's it's like it's more data, right? The more data you put into your model, essentially, right? I can put in data for the next 3 years, or I can put in data for the next 20 years. Then probably the better decisions I'll make, right? Because I have more better data in the data set. And so if I address, like we talked about, like the environment's always the easiest one because people can wrap their heads around it. If I address those concerns now with a long-term view, I should be positioned better as we go through the changes we're going to go through, right? And if my time horizon is only 5 years, I should exploit while I still have an opportunity, right, for the next 5 years, and like just yield as much as possible. I just have to have a larger framework for why I think it should happen, because that will help you make those. It's sort of like seeing the Matrix then, right? It helps you make those decisions anyway.
We're talking with Mark Hubbard, and the topic is, should I pursue impact investing? How does regulation play into the calculus of making an impact investment? Is it helpful? Does it stand in the way? Is it kind of just sort of there, but you don't care? How does that fit into your thinking?
Regulation and really future regulation, right, is how most people in this world would think about it.
Yep.
Absolutely plays into it. I mean, it's part of the determining factor for all of it, is that when you look at larger trends and you say these are things that are going to need to be handled, and by nature, some portion of that handling will happen through governments, then there will be future regulation of one kind or another. And the better I position for that now, right, then the better my business will probably be able to run. And so regardless of whether or not you like the regulation or not, right, the idea that you can prepare ahead of time by operating under the idea that those regulations are coming has paid off. And that's part of the ESG, framework that they argue for. It's part of why they say they tend to do better, is because as you lower the risk, as you adjust for the future of what you're going to have to face from a regulatory environment. And so, it actually presents sort of an opportunity for us, and we're only investing in things that would probably fit those regulatory frameworks well anyway.
Yeah.
And so, it's a plus for us, regardless of whether you think that's the way to solve problems or not.
Now, a question I want to make sure I get in. We're running out of time here, but I do want to get in, give you a chance to comment on it. Is, many of our listeners most of them are not. They're not fund managers like you are. They may have their own portfolios, but many of them are also business owners. They have their business thing that they do. And as you and I both know, when you're a small business, most of your investable wealth is the business where you're actually working every day. What advice could you give to them to think about how they might make impact investing work for their own businesses?
So I think there's sort of two levels for them, right? One level is the investable assets they have, and there's lots of resources for that now.
Yep.
Right. You can go anywhere. There's lots of places to learn. There's lots of nonprofits and industry associations, and every asset manager now has ESG portfolios, at least. There's indexes. There's low cost ways to do it. There's alpha ways to do it. There's funds, venture capital funds you can invest in. So that is one piece, and really that's just an argument for it. Just say to yourself, what do I feel like is it? What are my personal values? What are the kinds of things I'd like to see happen in the world? And if I'd like to see more of that, then I'm going to start voting with my dollars to make that happen. Right? And by the way, you can be reassured by the fact that the research says you're going to do just fine. Right? In fact, you'll probably do better. The next part is the business, right? If you're running a business or an employee in a business, or then you're inside one of the machines, and so there's an opportunity to do the same thing. Essentially, go to your bosses or look at your company that you founded and own and say, does this thing reflect what I say I believe about the world? And does it reflect what my employees say they believe about the world? And if not, how do I go about arranging things so that it's more integrated than it has been in the past? And again, lots of frameworks that are possible. I mean, B Corp, B Labs, you can go, they have a great framework. And so you can go through that framework and address all kinds of different categories. But I think we're at a moment when that's what people want to do, feel like they have to do. And I think it's going to be a good thing for all of us.
Mark, this has been a great conversation, but I have to let you go back to making the impact that you always do. But I know we didn't get to all the questions I had prepared, which I anticipated, but there are probably questions that the listeners would have wished that I had asked or wished that we would have stayed longer on. If somebody wants to continue this conversation with you offline, can they do that? And if so, what's the best way to contact you?
Yeah, sure. I'm on LinkedIn. You can find me there. Renewvc.com is the website. At the moment, there's about to be a full site launch, but at the moment there's a forum up there, so you could contact me there. On Twitter, MW Hubby. So yeah, no, the future in my argument is that the future of founders, the future of funders is all community. It's all going to be community from now on. And so, we want to talk to and engage and work with anybody that has an interest in this.
That's going to wrap it up for today's program. I'd like to thank Mark Hubbard so much for sharing his expertise with us. We'll be exploring a new topic each week, so please tune in so that when you're faced with your next business decision, you have clear vision when making it. If you enjoy these podcasts, please consider leaving a review with your favorite podcast aggregator. It helps people find us so that we can help them. If you would like to engage with me on social media with my chart of the day and other content, I'm on LinkedIn as myself and at Unblakeable, on Facebook, Twitter, Clubhouse, and Instagram. Also, check out my new LinkedIn group, Unblakeable's Group That Doesn't Suck. Once again, this is Mike Blake. Our sponsor is Brady Ware & Company, and this has been the Decision Vision Podcast.